Hi everyone! The pre-Christmas week on Wall Street ended on a relatively positive note. On a Friday, all three benchmark indexes rose moderately following the publication of inflation data. The Fed will remain committed to a hawkish stance next year. The economy is expanding, the GDP figure was revised upwards. All these factors allow the central bank to carry on with the monetary tightening. In December, the Dow Jones fell by 4%, the S&P 500 and the NASDAQ lost 5.9% and 8.7% respectively. They looked the worst annual performance since 2008. On a Monday, trading floors were closed on the occasion of the Christmas holidays. No crucial events expected in the shortened trading week. Investors are summing up their results before the start of the new year. Analysts wonder what to expect from it. The outgoing year has brought lots of unpleasant surprises, resulting in a drop in the stock indexes to record lows. In the last week of 2022, traders will be primarily focused on stock movements. They are still pinning their hopes on the Santa Claus rally, which would definitely bring some respite to markets. In the United States, housing market data and several regional PMI indexes are due. Watch our video review and find out more interesting details. Leave your comments down below and let's start. Risk appetite has remained subdued over the year. Stock markets have been shattered considerably by the coronavirus pandemic. When there was a hope for a recovery, another big problem arose, namely galloping inflation. Initially, many central banks did not take this issue seriously. However, after realizing their mistake, almost all regulators switched to monetary tightening. Fed Chairman Jerome Powell admitted that the situation got out of control as the watchdog misinterpreted inflation risks. In an attempt to cap soaring consumer prices, the Fed decided to raise the key rate at a record pace in history. Businessmen have repeatedly criticized the central bank because of the rising borrowing costs. After the rally in 2020 and 2021, the housing sector also faced a steep drop in demand. At the same time, the Fed is adamant when it comes to tightening. It's planning to hike the interest rate again next year. Eventually, the rate is likely to be raised above 5%. Elon Musk called on the Fed to cut rates immediately. This Fed rate increases might go down in history as most damaging ever. The billionaire said speculators have more than once priced in the likelihood of a softer stance. Such expectations even triggered short-term rallies. However, the outcome was the same. Stocks slid into a bear market, notching yearly lows. However, the Fed is ready to sacrifice economic growth to achieve stable inflation. The central bank seems unhinged even by the risk of a recession. Powell said that the top priority now is to tame soaring inflation. It remains to be seen whether the Fed will abandon monetary tightening next year. Perhaps market expectations of a policy reversal will be again in vain. As soon as the central bank slows down aggressive tightening, the risk-on sentiment will return to equity markets. There are only a few days left until the new year. It appears that in the remaining recessions, the stock indexes are likely to notch their worst annual results. The sentiment remains bearish as traders fear that the economy may slip into recession due to sharp rate hikes. Last week, the Dow Jones grew moderately after its losing streak in December. During that period, it declined by about 4%. At the same time, it fell by 9.6% on an annual basis. Relative to the January peak, the index shed more than 11%. As seen, the overall result is a negative. However, in comparison with the other indexes, the Dow incurred smaller losses. It's difficult for investors to make predictions. At a first glance, it may seem a good strategy to buy shares that are now significantly cheaper than the actual market price. Yet, it's not that simple. Corporate profits may contract amid mounting market risks. Investors will have to deal with lots of pitfalls next year. This is why it's so crucial to be cautious. In the outgoing year, stocks slid down when economic prospects started deteriorating. At the same time, no one could have guessed that the Fed would be so strongly committed to a hawkish stance. Even analysts were puzzled by the Fed's 7 rate hikes. Besides, there are lots of macroeconomic risks. Inflation is cooling very slowly. It may force the regulator to change the target of 2% to a higher one. For this reason, bearish sentiment remains strong. It's hardly surprising that some traders favor short positions, as there are plenty of reasons to sell risky assets. However, some speculators believe it's unwise to go short ahead of the new year. Even market players tend to believe that in the new year a miracle may happen and things could start looking up. The next year may intend to be better than the last one, although there are just hopes. As for the S&P 500 index, it remained almost unchanged last week. Yet there is one negative factor that should be taken into account. The index dipped below the resistance level of 3,850 points at the end of the year, so it might confirm the negative medium-term outlook for the index. It's projected to remain below the resistance level of 3,950. In December, the index was unable to recover, shedding 6%. It has fallen by almost 20% over the year. From the January highs, the index collapsed by 20.7%. As seen, it accrued larger losses than the Dow Jones. However, the NASDAQ is the main outsider. It's difficult to build a strategy and make a forecast. Nevertheless, some think things have unveiled their predictions. Goldman Sachs expects the S&P 500 to settle around 4,000 in 2023. Bank of America, HSBC and Citibank expressed the same point of view. Nevertheless, Goldman Sachs projected the index to end this year at 5,100 points. Its estimates turned out to be false. The reason is far below the forecast. Things may change drastically only if the Santa Claus rally takes place. What's more, all the risks that have been weighing on the stocks this year will remain relevant in the next one. Now the market situation is quite shaky. Market players will have to be patient before choosing an efficient trading strategy. Judging by the current trend, there are no signs of the formation of the bottom. Stocks have been unable to hit the bottom, which usually signals the end of a bear market. It means that bears are likely to remain in full control at the end of the year. NASDAQ finishes the week, months and a year with the worst results. It has incurred the largest losses due to the Fed's hawkish stance. On a Friday, it faced a strong bearish pressure as US GDP was revised upwards. As a result, NASDAQ added small gains and closed slightly above the pivot level. In December, its losses amounted to 9%. Over the year, it has sunk by 33%, remaining primarily in a bearish territory. Currently, it's trading 35% below the record high notched at the end of November 2021. Looking at technical indicators, it appears that risky assets are now at a crossroads. Since the start of the year, they have been declining despite the sell-offs that have been going on throughout the year. The shares of some companies could still bring high returns. For instance, Occidental Petroleum and Lockheed Martin stocks are quite attractive now. Shares of both companies added gains despite the downtrend. Next year, volatility will persist, and for this reason, it's necessary to consider long positions at the current levels, taking into account fundamental factors. Over the year, Occidental Petroleum stock soared by 115% amid high energy prices and increased global demand for oil. Shares of Lockheed Martin jumped by 36.8%. The outgoing year turned out to be extremely successful for this company. It's likely to show the best annual performance since 2019. Tesla stock is also among the winners. Despite positive results, Tesla shares have retreated from their all-time highs. Elon Musk has lost his title as the world's richest person. Overall, Tesla shares have slid by 38% since Musk bought Twitter. However, it could be a wise strategy to buy the stock at a cheaper price. Musk's controversial actions as a Twitter CEO adversely affected Tesla stock not long ago. He said he could buy a stake in a Tesla. However, these were just words. The stock price is expected to fall to $125 and then to $110. Judging by the current dynamic, it may occur in the near future. Tesla stock is declining along with the other shares of fast-growing companies as investors are looking for less risky assets amid recession concerns. Since the start of the year, Tesla shares have plummeted by 61%. Nevertheless, Tesla, as well as Apple, Microsoft, Amazon, and Berkshire Hathaway, entered the top 5 well-performing companies of the outgoing year. They were assessed by the following criteria: the largest turnover, demand, and of course news related to them in the media. And that's all for now. Subscribe to our channel and keep close tabs on the market developments. See you soon.